Hi, I'm Sherry Borshoff. I'm an enrolled agent and I'm the founder of Bastion Business and Tax Services. And this is part of building your financial fortress, especially your tax strategy and compliance wall. If you're operating your business as an LLC, one of the most important tax questions you'll eventually face is this: should I elect to have my business taxed as an S corporation? The answer is maybe. An S corporation can save you thousands of dollars each tax year, but it isn't right for every business, and making the election too soon can actually cost you money instead of saving it. Today I'm going to explain what an S corporation actually is, when it makes sense to make the election, when it doesn't, how much you could potentially save, the mistakes I see that business owners make from time to time. Now let's get started. First, I want to explain what an S corporation is. One of the biggest misconceptions I hear is I formed an LLC, so I'm not an S corp. Actually, an LLC and an S corp are two different things. An LLC is a legal structure. An S corporation is a tax election. Think of your LLC as the vehicle. The S corp election simply changes how the IRS taxes that vehicle. In many cases, you can keep your LLC exactly as it is and simply elect S corporation treatment. Why do people elect S corporation status? The biggest reason is to reduce the employment tax. When you're sole proprietorship or a single member LLC, all of your profit is generally taxed by federal income and self-employment tax. That self-employment tax is currently 15.3%, and it is the mandated Social Security and Medicare deductions. If you're going to become an S corporation, you do have to pay yourself a reasonable salary. Your salary remains subject to payroll taxes. However, the distributions do not have any subjection to self-employment taxes. Let's assume your business earns $100,000 as a sole proprietor. You may pay yourself the entire $100,000 as an S corporation. You might pay yourself a reasonable salary of $50,000. And you could take the remaining $50,000 of that through a distribution. That means you're paying only payroll taxes on only the salary portion. The potential savings is where you could take those distributions during the year. So, should you consider becoming an S corporation? There are rules. Rule number one is consistent profitability. I typically don't recommend an S corporation if you're not making a consistent net income or your cash flow is terribly unstable. You need to have predictable cash flow and stable operations. If your profits fluctuate wildly from month to month, it might be premature. The second rule is at least $40,000 to $50,000 in annual profit. Every situation is different. However, many tax professionals start analyzing the S corporation election once net profits reach approximately $40,000 to $50,000 annually. Below that level, the additional costs may offset any savings that you are trying to reap from electing to be treated as an S corporation. Because remember, an S corporation does create additional expenses. You'll need a payroll processing and a corporate tax structure. You'll need corporate tax returns, which is a separate tax return from your personal tax return. You will need additional bookkeeping services, and there are additional compliance requirements centered around being an S corporation. So the tax savings need to justify those costs. Rule number 3 is you have to be able to pay yourself a fair and reasonable salary. This is where many business owners get into trouble. The IRS requires shareholder employees to receive a reasonable salary from their S corporation. You can't simply make $200,000 and pay yourself $10,000 in wages. That will not fly. The salary must be reasonable and based upon what the industry standards are in your industry, the duties that you're performing, and your experience. Basically, I tell my clients, what would it cost to hire somebody to do what you do? So you have to look at time invested, geographic location, experience, and what reasonable salaries for comparative jobs are. The IRS does specifically audit S corporations for unreasonable compensation, so you need to make sure that you are making the best choice and paying yourself the right amount of salary to be compliant. The rule number 4 is, are you ready for additional compliance? Many business owners focus only on the savings and then they forget the responsibilities. So an S corporation is going to require payroll filings, W-2 reporting. It is going to require a corporate tax return and proper bookkeeping. As always, with any business, I always suggest separate accounting records, separate bank accounts, but it's very important that you stay compliant with all of these things. If your books are a mess, an S corporation is probably not the step for you right now, because good bookkeeping should come first. Okay, so when should you not become an S corporation? Here are a few situations where I would advise a client to wait. 1, you're not making consistent profits. 2, your business made, say, $70,000 last year, but it's only making $15,000 this year. So an S corporation may not end up providing you with meaningful savings. If you don't want to do payroll, then you probably don't want to be an S Corp, because payroll is not an option. If you become an S Corp, you generally need to run payroll at least once a month to pay yourself that fair and reasonable salary. And some owners resist this because it feels complicated. At Bastion Business and Tax Services, we make it easier for you. But if you're unwilling to run payroll, then don't elect to be an S corporation. So if your books aren't accurate, also, one of the biggest mistakes I see is business owners electing to be an S corporation, but their books aren't. Then their books they don't keep up with the bookkeeping, and they don't run payroll, or they take random draws throughout the year. These things become a recipe for an eventual IRS problem. The biggest mistake owners make is electing S corporation status because somebody in social media said everybody should be an S corp. That's simply not true. An S corporation is a tax strategy, and like every tax strategy, it must fit your specific situation. I've seen business owners save $10,000 per year with an S corp, but I've also seen business owners spend more in compliance costs than they could save. The answer depends greatly on your accounting and your bookkeeping numbers. What is your income statement telling you? So my final thoughts is, if your LLC is consistently profitable, generating at least $40,000 to $50,000 in net income, and maintaining good bookkeeping records, and you're ready to run payroll, then it may be time to evaluate whether an S corporation makes sense. But the key word is evaluate. Don't make this decision based on social media. Make the decision based on what your real numbers are telling you and what your tax analyst can show you as far as what the election might save you in your business. And remember, the goal isn't only to pay the least amount in taxes possible. The goal is to build a strong financial fortress around the business while staying compliant with the IRS rules. I will have more videos like this in the near future. So if you found this helpful, you can subscribe and leave any questions you have in the comments below. I look forward to helping you build a stronger business and a stronger financial future. And I'll see you in the next video.